Are you worried about when your mortgage is about to renew and the steep increase in payments you're going to experience? You should be.
Bank of Canada is once again reminding Canadian borrowers adjust to the new reality of higher interest rates and prepare for more pain from the 10 rate hikes that began 20 months ago.
So I had a whole script done up, typed out, perfected, filmed, ready to go. And then the Minister of Finance, Chrystia Freeland, came out with the recent announcement of the Canadian Mortgage Charter, which is important to include.
Today, I am announcing the new Canadian Mortgage Charter.
So I had to go back to the drawing board a bit and make some room and change some stuff around to be able to include that as well. What does this new announcement mean and how will it affect Canadians? There are 6 major guidelines for banks, which I'll let you read here, and I'll highlight and discuss some of the big ones. 1. Allow temporary extensions on amortization periods for mortgage holders, which means you can extend the amount of time it takes to pay off your mortgage. Instead of stretching your mortgage over 20 years, you can, for example, extend it to 30 years, thus reducing your payments, but you will be paying more in interest every month. 2. If you have an insured mortgage, you are exempt from having to go through a stress test again to see if you can properly afford the house you currently have at the time of your renewal. 3. Borrowers are allowed to make lump sum payments to avoid negative amortization. Payment amounts are not paying down your principal and is going primarily or solely towards the interest on your mortgage. Now, it's worth mentioning, banks don't actually have to comply with these new guidelines that Chrystia Freeland has laid out. However, she has said it's really something for the Minister of Finance to lay these out and for banks not to follow it when it's clearly in black and white. So this does seem like a good effort the Canadian government is making. It's a start. On the other hand, some people are obviously upset with this decision as they feel this is a bailout and they're wanting house prices to fall so that they could get into the Canadian housing market. In any regard, it's some relief for homeowners. There are some people that are speculating that interest rates will fall next year.
Interest rates are going to come down a lot faster and a lot harder than the market thinks.
How much do you think?
Well, again, we'll have to watch the data a little bit, but, I would think 100, 200 basis points next year is pretty realistic.
Now, it's hard to say what they're going to do next year and the year after, but I think this cycle will see at least 300 basis points.
However, don't rely on that. As they say, pray to God, but row for the shore. Hope for the best, but plan for the worst. If you watch this video all the way through to the end, you'll be very glad you did with the financial tips that I'm giving you. You'll come out much farther ahead in the long run. I think why many Canadians are kind of upset and annoyed at this situation is the cost of living is nothing new in Canada. We've seen this coming and we've been experiencing it for years. An increase in the cost of food, gas, clothing, now housing.
As the cost of living continues to rise.
The cost of living, higher interest rates have stretched more than half of Canadians' budgets to near the breaking point.
It's just been over the last few years that we've really noticed this impact, particularly to housing. Many people or outside spectators will drop their opinions and say, oh, it's not that bad, is it? Or you can just move, it's that simple. Or you just got to tighten your belt a bit more, or just make more money. I don't think they really understand the impact that this is having on Canadians, and it's not really that simple. That's okay, it's a complicated problem, as it's hard to grasp and understand the full scope of what is happening. It's not quite as easy as simply say to people, oh, you simply have to move or tighten your belt on your expenses a little bit tighter more than it already is, when people are pretty much maxed out, often as far as they can go already. And in many instances, that's easy for them to say because they are not in that situation. Many people are familiar with the videos they see all over the place saying, the reason why you're broke is you need to budget more. You don't buy that fancy car. You're eating out too much. Consider buying no-name brands. Consider what we're going through with this housing crisis. Many of those things no longer apply. People's dollars and wallets are already stretched paper thin. So many of those aren't really relevant to our situation.
At some point, there's going to be nothing left to cut. And that's going to leave people with very little financial wiggle room.
They're about as useful as those 3-foot cords you get with controllers with PlayStation consoles. They're nice to have, but oftentimes you can't do anything with them. If you're new to my channel, welcome. I'm Aaron, a 20-year corporate accountant and analyst. I discuss personal finance, investing, and shifting your money mindset. Everyone knows those people that go out and spend money on stuff they just don't need, or take numerous vacations paying with everything on credit. However, there are other people who are financially prudent and have tightened their belts and stretched their dollar as far as they could possibly go, and it's still not enough. The average person should not be forced to work 2 jobs with 80-hour work weeks just to be able to afford basic necessities. If so, there is an issue with that country's economy.
You couldn't afford this thing if you lived to be a million.
So one of the main problems in Canada and America currently is too many people are standing up. What do I mean by this? Well, say you go to a concert and you're in the 10th row and you can't really see the stage that well, the singer performing, so you stand up. Suddenly you have a much better view. Suddenly other people start to stand up, and then more, and pretty soon you can't see nothing. So what are your only options? Well, you have to get up even higher. So you stand on a box or a crate, put it on your chair, and suddenly you're able to see. You see where I'm going with this. People keep standing up, raising the bar higher and higher. You have a degree, suddenly a lot of other people have degrees. You have a side hustle. Suddenly many other people are earning side incomes and side hustles, supplementary income as well. So it's becoming really hard to make ends meet and to stand out and get ahead in Canada and America. Unfortunately, there aren't a lot of options other than to increase your net income or decrease your expenses. Think of it like a sink. Water represents money. Your net income is the taps, it flowing into and filling up the sink. The drain would be your expenses. So either you have to cap your drain, cap your expenses going out, or you have to bring in more taps and more water flow, filling up the sink, increasing your income sources. That's the only way. It'll always be 2 sides to that equation. If you feel like you're getting something out of this video, would you do me a favor and hit the like button? Very much appreciated. About 2/3 of Canadian mortgages, both fixed and variable, will be renewing in the next few years.
The people most concerned are those who may have just entered their mortgage agreement and are now faced with the prospect of unaffordable payments for 25 or more years.
By the end of 2026, virtually all remaining mortgage holders will go through a renewal cycle, and depending on the path for interest rates, may face significantly higher payments.
Realize that rates will not go back to those low levels, so don't hold out hope. Anyone who feels that they are in trouble should adjust and maybe make some moves now before they face that tough music that's coming ahead.
Here are the current interest rates from the big 5 Canadian banks. Many people are concerned about how they're going to come up with that increase in their mortgage payment that is set to renew in the next few years. And they should be. I'll go through several great options to consider that you can go through and apply with no fluff, no filler, of practical things that you can do to help bridge the gap between your current net income and your upcoming increase in your mortgage payment. Previously, if you had a $600,000 mortgage of 2% over 25 years, your monthly payment would be $2,541. Now, going by the new rates of approximately 6.49% for 25 years, your mortgage payment will be $4,015 per month. And this is the exact calculation also confirmed using the RBC mortgage calculator. That's a $1,474 increase each month. So how can you bridge this gap, like I mentioned, for when that mortgage renewal payment starts to increase? The very first and most important thing that you can do is to meet with your mortgage lender, ideally 3 to 6 months before your mortgage renews.
Mortgage specialists like Spiros Couliras say even if you're on a fixed rate, it's a good idea to be thinking about the renewal in advance.
Contact a mortgage professional and see what they can do to help you.
You want to be prepared and plan so that you meet with your lender, you discuss options, you see what's available to you. Then right after that, you want to meet with 1 or preferably 2 mortgage specialists. You want to see what it is they can offer you as well. The better financially prepared you are and you have a budget and plan thinking about how this will impact your financial situation, You'll be much farther ahead than if you only have, say, 1 week until your mortgage renews and you're scrambling to see what your options are and who you can go to, where you can get your best rates. The second option that I want you really to consider is people's primary expense. Most of their income goes towards paying their mortgage. So let's go to where people get most of their income from, your job. I want you to go and ask for a raise. If you approach your employer, set up a time to meet with them and go in and have this all laid out, logically presenting your case on how you've streamlined processes, improved your workflow, put in long, consistent hours, and you know you're a good employee, this often works. Those who ask for a raise are far more likely to get one than those who just sit idly by. If you have confidence in yourself and can present your case logically, your employer is far more likely to give you a raise than if you say nothing at all, because it shows you have confidence and you're sticking up for what you believe in. And you can quote that it's due to partially to inflation.
According to new numbers from Angus Reid polling, 49% say they're in a worse financial position than they were last year. And here are some of the top issues facing Canadians.
Now, some employers will give you an incremental raise of 1 to 2% and say, oh, this is to compensate for inflation. We feel that's fair. Well, that means nothing to me. When I get raises such as that, that's meeting the bare minimum. Actually, inflation, going by 2022 numbers, is closer to 6 to 8%. And some people feel that this number was underreported and the actual number is closer to 11%. So when employers toss out a 1 to 2% raise, you're actually making less money than you were the year before. So it doesn't really help you at all. The company is looking out for itself and expecting you to work hard. So I think a fair requirement would be for the company to do the same for you. If that didn't work, going to your boss or manager and asking for a raise, then depending on your level of position and how confident you are in your abilities, you want to consider applying around for other jobs. Many people, after they've been in their job about, say, 5 to 6 years, will hit what is called wage stagnation. Eventually, your wages won't, or your salary won't increase by a whole lot year over year. You'll pretty much start to cap out. However, employers, in order to remain competitive to new prospects, they continually offer 10 to even, I've heard, 20, 30% raises to new hires. That's why somebody who maybe just got hired into a new role could potentially be making more than somebody who's been there 5 to 7 years. Because in order for the company to remain competitive to new prospects, they offer a higher wage to new hires. So after you've been in your role for about 2 years, it's usually good to just test the waters and see what's out there, what other employers can offer you. I imagine most people could benefit from a 10 to 20% increase in their gross income. Another great thing to consider, and I've done this personally, is to look into decreasing your home insurance. Consider maybe bundling your home and auto insurance, but also negotiate. Don't be afraid to call up, say, utility companies or especially home insurance and auto insurance companies and look into what packages they can offer you. Often, if you bundle your home and auto insurance, you can obviously save, most people know that, on those packages. A true story, a few years ago, I called and renegotiated my home insurance. We lived in an 1,800 square foot house, and I called one day after researching a bunch of home insurance companies, called up my home insurance and said, look, I am paying $2,400 a year for a full package of home insurance, and it just strikes me as really unaffordable, and I'm thinking about switching. And I was prepared to leave. I'm going to go with another company. So the guy put me on hold. He sorted around, did some paperwork, and after 15, 20 minutes, he came back and he had dropped the price that I was going to pay for home insurance for the year by half. I only paid $1,200 instead of $2,400 per year. And the real kicker is nothing changed. Not one thing changed in my home insurance package. So yeah, I was a sucker. I overpaid for a number of years, but I'm a lot smarter now, and I know to ask, and don't be afraid to negotiate. It can save you hundreds, maybe thousands of dollars over a number of years. So that's a $1,200 savings over a year. Another great tip is when people are looking around for a mortgage, they do what I did. You look around, say, who has the lowest interest rate? Okay, I'm going with that. Mortgage specialists will tell you this. You also want to look at the package, not just the interest rate. A great example of this is the payout penalty. Many people never think about it and they say, what do I care? 1 in 5 people break their mortgage. What is the cost if you break your mortgage? Do you know? How would you calculate that? Well, it's usually a percentage of how early you broke your mortgage payment. This could be thousands of dollars, but most people never consider it. They just think about the interest rate. You want to go to your mortgage specialist and say, not what is the lowest interest rate, but what makes this mortgage better than every other mortgage out there, and see what it is they say. Another great option to consider is maybe getting a renter, renting out a room or maybe your basement suite. There are many great renters out there, and depending upon your housing situation and how you're set up, you can ask for anywhere from $800 to almost $2,000 easy for a place. Say it's an extra room or maybe a basement suite. It depends obviously on the setup you have in your house. If it's a walkout basement suite, if you have a kitchenette downstairs or something you can offer. This is something really to take into consideration because 1 in 5 Canadians has the extra space and can offer it to a renter. And this is kind of the ultimate passive income because you already have the space available. You don't have to do anything extra. Maybe there's a little bit extra utilities included and the inconvenience of it, but I would really consider this. I had renters in my place and I had no problem with it. Now, ideally, this isn't great if somebody has a family. Maybe you have to take that into account, safety and security. But if you're fine with it, this is a great option to take into consideration. Something else you'd never want to forget about and always take into consideration is with that increase in your monthly mortgage payment, having the proper disability, life insurance, job loss insurance. So make sure to talk to a life insurance specialist to see what program is best for you. It is well worth the money and it just takes a little bit of extra work to see what plans you qualify for. It is well worth the investment. Consider whether you want to stay with your current mortgage lender or want to switch. Ask your mortgage broker or specialist about, is there a fee for their service? Should you go with variable or fixed interest rates? And what are your options for switching? How can you save on interest? What prepayment privileges does this mortgage offer? What kind of closing costs should I budget for? Are there any restrictions on refinancing this mortgage? The cost of changing lenders and what the process is. What the benefit is in staying with the same lender. Are there home appraisal fees? Mortgage loan insurance premiums? The amount of your loan increases, amortization periods, and options available for extending those periods. Payout penalties if you break your mortgage and have to sell early. Prepayment options and your options for making additional payments. Disability, job loss, or illness insurance and coverage. Look into whether you want your mortgage through a bank or through another lender, as there are pros and cons to each. If you can, consolidate other debts onto your mortgage. I love Canada, and I really hope we get back to where we were 20, 30 years ago. However, it seems lately that we've been progressing down this hole where it seems to be getting a little bit worse every year. Cost of living is going up, then food, then gas, and it's becoming unaffordable. And I'm sorry to say, you kind of feel like we're failing millennials and young people just looking to buy a house. That's all they want. They just want to be able to afford a house and live how mom and dad lived. Just live in a simple home. And now that's even becoming more out of reach every year. They have to scrimp and save and try to come up with that down payment. And it keeps getting pushed further and further away from them.
Ongoing interest in the Housing Accelerator Fund. A lot of critics say that'll still take many years for those homes to be built, for the shovels to get in the ground, and for those homes to be finished. In the meantime, we're all facing an affordability crunch, particularly right now.
Although nearly 70% of millennials have higher education, as opposed to 30% of boomers in 1976, wages have remained stagnant while the cost of living has shot up, and housing is more than double the price today than that of 1976.